When it comes to investing, nothing is guaranteed, except that you'll need to report your investments on your federal income tax return. Gathering all your tax documents together and filling out your tax return can seem like a daunting task. This webinar will help you understand what all the forms are for and how to get the information that you need. Whether you file your own taxes or hire a professional, we'll also explain how investments are taxed and how to report different kinds of transactions you've made throughout the year on your tax return. We'll also give you a few tax tips that might help you pay Uncle Sam a little less tax this year. Let's start with the paperwork. Generally, your 1099 forms report income other than wages. There are several types of 1099 forms that you may receive. These include 1099-B, which reports capital gains and losses. 1099-DIV, which reports dividend income and capital gains distributions. 1099-INT, which reports interest income. And 1099-R, which reports distributions from retirement accounts. We'll take a closer look at the 1099-B and 1099-R a little bit later. Just keep in mind that portions of your 1099 may be consolidated into a single 1099 form at your financial institution. For example, you may find that your 1099-DIV, 1099-INT, and 1099-B for your brokerage account all summarize on a single page referred to just as a 1099. Also, you might not always get a 1099-DIV or a 1099-INT if your account didn't generate at least $10 of income during the previous tax year. Finally, if you own a professionally managed account, including a mutual fund, you will likely get a 1099 even if you didn't sell your fund shares or request a withdrawal from your account. That's because your portfolio manager is regularly trading throughout the tax year. Those trades can generate realized gains or losses that will need to be reported on your 1099. There are other less common types of 1099 forms that you may receive if you invest in certain types of securities or accounts or perform certain transactions. These include 1099 Miscellaneous, which reports substitute payments in lieu of dividends, and 1099-Q, which reports distributions, including transfers to another financial institution, from Coverdell Education Savings accounts and 529 accounts. So, when should you expect these forms? For your mutual fund accounts, you can expect to receive forms in late January, and for brokerage accounts, in late February. Be aware, your 1099 could be amended. If your 1099 is amended and you file your tax return, you'll need to amend your tax return. We'll talk about why this may happen and what you'll need to do in a few minutes. For now, let's take a closer look at the 1099-B. When your tax professional requests the cost basis of your investment accounts, he or she is asking for your 1099-B. The 1099-B is used for determining any taxes on your sales of securities. You'll receive a 1099-B on any non-retirement accounts, including joint or individual investment accounts, UGMA or UTMA custodial accounts, all types of trusts, including living and irrevocable trusts, corporate investment accounts, and any other non-retirement account. On your federal income tax return, you are responsible for reporting your cost basis information on your Form 8949 and Form 1040, Schedule D for all shares sold. Some brokers, including Folio Institutional, may prepare the 8949 form for you. In this case, you'll need to print the Form 8949 and attach to your tax return. Here's an example of a 1099 from one of our brokers, Folio Institutional. On the second half of the first page, you'll find the cost basis summary. We circled it in red in this example so Folio clients will know where it's located. The first line is for short-term transactions that were reported to the IRS. It shows the gross proceeds, the cost basis, if there were any wash sales, and the net gain or loss that resulted. The next two lines don't have any values associated with them. The next transaction here is a long-term realized gain reported to the IRS and followed by long-term realized gain not reported to the IRS. You will report all these transactions on your 1040 return. Note that although this 1099 is 54 pages long, the information you need is summarized for you on the first page. One column on your 1099-B may include a value under wash sales. A wash sale occurs when a security is sold for a loss and a substantially identical security is purchased within 30 days before or after the date of sale. When this happens, the loss is disallowed and can't be deducted. The disallowed loss is added to the basis of the purchased security as reported here on this 1099-B. This reduces future gains or increases future losses. You will report any wash sales on your tax return. Here's an example. Say you purchase 100 shares of Cardinal Health for $33 for a cost basis of $3,300. You sell the shares at $30 for proceeds of $3,000, and within 30 days you buy 100 shares at $32. Your loss of $300 would be disallowed by the IRS and considered a wash sale. But your loss can be added to the $30,200 cost of the new purchase. In addition to the 1099, you may also find that your broker has prepared for you a Form 8949. Here's an example of how Folio's Form 8949 looks. The first part shows you the securities that were traded and resulted in short-term realized gains or losses. This total column adds up the proceeds, cost basis, and realized gain or loss that is short-term. The second part shows you the securities that were traded and resulted in long-term realized gains or losses. Again, this column adds up the proceeds, cost basis, and realized gain or loss that is long-term. Depending on when you started your investment account, you may have two more transactions to report. These are referred to as uncovered or cost basis that was not reported to the IRS. For example, if you acquired stocks before January 1st, 2011, or mutual funds before January 1st, 2012, you'll see these transactions referred to as uncovered or not reported to the IRS. You will need to report the cost basis information for these transactions generally in the same way you report your covered or reported to the IRS cost basis information. The information on your Form 8949 is identical to the information summarized on your 1099-B. Keep in mind that not every broker will prepare the 8949 form for your brokerage account. If your broker does not, then you'll need to report each individual securities tax lot on your tax return. To recap, if you own an investment account, you need to request and use the information on your 1099 so you can report your cost basis, dividends, and any interest. It's ready late January for mutual fund companies and late February for brokerage companies. Your 8949 form. If your broker prepares it and you have a brokerage account, then you'll have this. If not, you'll need to complete this form yourself using the cost basis provided to you by your broker on your 1099-B. Throughout the process, you'll want to make sure your 1099 hasn't been amended. We briefly mentioned earlier that your tax statements may be corrected or amended due to income reclassification. Your financial institution receives income reclassifications and other similar adjustments from companies that issue stock or mutual funds after year-end statements have been processed. Under IRS regulations, your financial institution must provide amended tax statements and report the updates to the IRS when it receives that information from companies, including mutual funds, that you hold in your account. You must report the change on your tax return. We recommend you work with a qualified tax professional to determine how these changes may affect your tax return. Generally, dividend-paying stocks, including real estate investment trusts, are more likely to reclassify their income. If you own an investment likely to reclassify, you may want to delay filing your tax return until late March or early April to avoid refiling. Now let's talk about retirement accounts. If you have a retirement account, you may also receive a 1099-R from your financial company. You can expect to receive a 1099-R if you owned a retirement account and took a withdrawal, removed an excess contribution, converted to a Roth IRA, recharacterized the contribution, or completed a rollover into an IRA from your employer 401k. Receiving a 1099-R does not always mean you will owe the IRS taxes. However, it does mean that you will need to report the information on the form on your tax return. You will receive your 1099-R by mid-January for mutual fund accounts and late January for brokerage accounts. Another form you may see in your account is a 5498. This form is used to report your total annual IRA contributions. It's sent directly to the IRS by your mutual fund or broker. It's not ready until mid-May because you can make IRA contributions for the previous tax year until April 15th of the current year. Generally, it's not necessary when preparing your tax return, so don't waste time on it. If you have an IRA account and you see a 5498, you can generally ignore it. Let's turn now to common tax reporting mistakes. We see clients receive IRS letters for 3 common tax reporting oversights. These are not reporting non-deductible IRA contributions. When you make a deductible traditional IRA contribution, you will report your contribution on your personal tax reform 1040. You should make sure that the financial institution's records match with what you're reporting. You should also make sure you haven't exceeded the maximum allowed under IRS rules. However, what should you do if part or even all of that contribution was non-deductible? You need to tell the IRS what portion of your IRA contribution is made up of non-deductible money. To do this, you must file IRS Form 8606. Next, not reporting IRA conversions to a Roth IRA. When you convert a traditional IRA to a Roth, your financial institution will issue you a 1099-R to report the withdrawal. You will need to use the 1099-R to report the conversion on your 1040. Lastly, not reporting a rollover from an employer plan into an IRA. Anytime you roll over a 401k or other employer retirement plan into an IRA, you must report the rollover to the IRS using the 1099-R form. This 1099-R form will be issued to you by your employer's retirement plan. This brings us to tax treatment for investments. Understanding the tax you pay on your investments is the first step toward paying less taxes. When you sell a security at a profit, you will usually get taxed if it's held in an investment account. If you sell a security within the first year you own that security, you will pay taxes at ordinary rates that can be as high as almost 39.6% for 2017. This is called a short-term realized gain. However, the tax code encourages long-term investing. So, if you hold that same security for longer than a year, you'll pay a lower rate at a maximum of 20%. In this case, you will have a long-term realized gain. What does this mean for you? It means you should strive for long-term, i.e. more than a year, and low turnover investments in your taxable accounts, and minimize frequent trading whenever possible. Keep the higher turnover and more frequent trading for your retirement accounts where any gains will grow, tax-free until withdrawn. The information you see on your screen now applies to your 2017 taxes, which are due in April 2018. The new brackets from the recently passed tax cut bill will go into effect for your 2018 taxes due April 2019. Now that you understand the paperwork you need to gather and how your investments are taxed, how can you reduce your tax bill this year? Keep in mind that the window of opportunity for many tax-saving moves closed on December 31st. First up, maximize your contributions in tax-advantaged retirement accounts. Be sure to take full advantage of tax-advantaged retirement savings, like traditional IRAs and 401k accounts, when appropriate. These plans allow you to contribute funds on a deductible, if you qualify, or pre-tax basis, reducing your taxable income. Contribute the maximum amount allowed to all your retirement accounts. Contributions to a Roth IRA, assuming you meet the income requirements, are not deductible or made with pre-tax dollars. However, qualified Roth distributions are completely tax-free from federal income tax, which can make these retirement savings vehicles appealing. Next, convert to a Roth IRA. Consider whether it makes sense to convert a tax-deferred savings vehicle, like a traditional IRA, to a Roth account. When you convert a traditional IRA to a Roth account, the converted funds are generally subject to federal income tax in the year that you make the conversion, except to the extent that the funds represent non-deductible after-tax contributions. If a Roth conversion does make sense for you, you'll want to give some thought to the timing of the conversion. For example, if you believe you'll be in a better tax situation this year than next, you might want to think about acting now rather than waiting. Keep in mind that depending on your situation, you can hold more than one retirement account at the same time. For example, you may contribute the maximum amounts to your 401k and to a non-deductible traditional IRA as well. You may not get the deduction from your non-deductible IRA, but you can still convert it later to a Roth IRA and take advantage of tax-free growth and withdrawals at retirement age. If you're a business owner, you'll have even more flexibility and options at your disposal. So, contact your financial advisor to make sure you are taking advantage of them. Let's mention here that taxes can make a big difference to your bottom line. Let's assume two people have $5,000 to invest every year for a period of 30 years. One person invests in a tax-free account like a Roth that earns 6% per year, and the other person invests in a taxable account that also earns 6% each year. Assuming a tax rate of 28%, in 30 years, the tax-free account will be worth $395,291, while the taxable account will be worth $295,896. That's a difference of $99,395. Now back to the tips. Next, consider harvesting losses in taxable accounts. Make sure you review the realized gains and losses in your taxable investment accounts before the end of the year. Specifically, look at your realized short-term and long-term transactions. Most brokers will have this preliminary information summarized for you. Depending on your situation, you may want to consider harvesting losses to reduce gains. This is a common technique used late in the tax year. It involves realizing losses to try to offset gains made throughout the year. Just be careful about the wash sale rules, which we mentioned previously. Also, remember that taxes are only one part of investing. You won't want to harvest losses in cases where it could potentially hurt your portfolio's growth potential. Finally, donate in a tax-smart way. If you're already charitably inclined, make sure you do it in a tax-smart way. For example, if you're required to make minimum distributions from your retirement account because you are 70 and a half or older, and you are fortunate enough not to need this money, consider making a qualified charitable distribution from your IRA directly into a qualified charity. A qualified charitable distribution will satisfy your RMD requirement. Even better, this amount gets excluded from your taxable income. You can donate up to $100,000, but you must use the check writing privileges on your brokerage account so that your transfer is made directly from your retirement account to your charity. There are other tax-smart ways to donate to charity that can help you reduce your tax bill. Check with your advisor for more information. For assistance and help with filing your taxes on your investment accounts, please refer to IRS Publication 550 or Investment Income and Expenses, available online at irs.gov, or call the IRS at 800-829-1040. Keep in mind that reporting your investments in a taxable account can get complicated, so we urge you to seek the assistance of a qualified tax professional. Remember, every situation is unique, and you can find general tax preparation information on our website, azadfunds.com. And that concludes today's presentation. Thank you for your time.